It has been a volatile year, David, but mostly everything heading up. An extraordinary year. Everyone knows stocks are on a tear. What they might not know is that investment-grade bonds are up 7%, high yields up 6.5%, even triple Cs are in the black. How should an investor reallocate now?
Well, Eric, the dominant theme right now is the broad consensus that interest rates are going to stay low and low for a long time. In fact, it's never been more punitive to hold cash. And what that's doing is it's driving people out of cash and into almost anything that they see as a yield. As you point out, we've seen dramatic flows into all kinds of credit products, into emerging markets, into high yield, and also into the equity markets where we've seen a real run up as well. So I think you can see this hunt for yield really on steroids during 2021. And I don't see an end to that in sight as long as there is this broad consensus on rates.
Now, if there's a hunt for yield, David, it goes down that cascade of the capital structure. Does that mean in your mind that equities are going to have another extraordinary year and everything else with, some kind of risky flavor to it, whether it be, mezzanine debt, whether it be, preferred equity, also enjoys incredible gains?
Well, we do believe that risk assets are going to have a good year. We think that the money that we've put to work over the last 6 months, when you look at it over the long run, will have had an extraordinarily strong vintage. And we believe that the next 12 months will be very strong as well. Now, that is, of course, counting on the fact that we will have a vaccine that is broadly available and that the global economy will gradually recover in the second half of next year. Just to give you some sense of that, I mean, our numbers are that the U.S. economy basically shrank by almost 4% this year, but it'll grow by 4.5% next year. So we'll have pretty much of a recovery by the end of next year in terms of broad GDP growth. And that gives you a pretty powerful backdrop to be constructive on risk assets.
David, it's one thing to predict returns on the basis of anticipated flows. It's another thing to look at valuations and try to explain where they are. There are at least two main arguments underpinning equity valuations today. One is that the collapse in nominal and real rates raised the present value of future cash flows and so pulled returns forward. And the second, of course, is the pandemic supercharged business models. And so there's more embedded growth in stocks that investors didn't previously recognize. Do you buy either of those arguments?
Well, I think the first one is simply math, and absolutely we do.
I guess excuse me. Let me interrupt. Now that rates are at zero, can that argument explain future gains?
So it can, and in fact, it absolutely at the current levels will support a growth in the equity markets even next year. And as you point out. Right now, it looks like we will have a return to fairly strong earnings growth by the second half of next year. And between those two, you can absolutely see your way to feeling that the equity markets are not overpriced in aggregate, although we can talk about specific areas.
Okay. I have a question for you about SPACs, because they have clearly been one of the phenomena of the 2020 equity market. Do you see them as an ingenious tool for unlocking growth, or a get-rich-quick scheme that's going to end in tears?
Well, I'm not sure I would choose either of those, but they aren't structures that I'm personally very comfortable with. I think that we have generally seen, whenever we've gotten to having too much risk capital, that we have these very unclear sources of capital that are given very broad mandates to move wherever they want. And personally, I begin to see that as a little bit of a sign of a bubble rather than as an ingenious new invention.
Is that to say that PGIM is avoiding SPACs, or just being very careful about it?
We're being very careful and very cautious. It's not something that we invest in directly, and I think that we don't think that many sophisticated institutional investors are moving in that direction either.
So for something to happen, the bubble needs to pop. If equity valuations and returns continue to be robust, as you expect. What is it that's going to pop the SPAC bubble?
Very hard to say, at least in the short term, and I think that's why we're pretty constructive on risk assets. I think what you have to believe, though, is that the seeds of any cycle are sown in the upswing, and that as more and more capital does come out of cash and into risk assets, you will start to see some of the people who've reached well beyond what they can actually handle from a risk point of view begin to have trouble. But I think we're a good 18 months away from anything like that happening. We're still in the early phases of a recovery.
David, there's been almost $50 billion of deal-making consolidation in investment management over the course of 2020, some of it for vertical integration, some of it to gain scale, some of it to add specific capabilities, bolt-on deals, if you like. What role is PGIM going to play in that frenzy?
So we would expect that there'll be more deal making in the next year. There's no question that this broad trend toward scale at one side and specialization on the other is continuing to take hold. And the guys who are kind of mediocre and in the middle are getting squeezed very badly. And we expect to see more consolidation as a result of that. Now, for us, we believe that what's different about the asset management industry is that it's a fiduciary business. That is, that we put the needs of our investors first and ahead of our shareholders. And what that means is that when you evaluate a deal, you need to make sure that it's adding value for your investor clients. And deals that do that have tended to work out fairly well in the industry. Deals that have been predicated on smashing investment functions together, taking out costs, and effectively are driven by shareholder needs like margin expansion, have not worked out well and resulted in a lot of outflows. And so we very much want to avoid the latter, and we are certainly in the mix on the former.
Should I take it from that, David, that you have been looking at things and passed on them either because they weren't going to be accretive enough or they weren't going to be able to fulfill your belief and mandate to be a fiduciary?
Yes, and also some of them have just been very pricey. There's no question that to some extent the downturn didn't hang around long enough to really drive pricing down, and many players, including many of the big banks, have decided that they also want to expand their investment businesses, and so high-quality businesses are actually going for quite a premium, and we've seen that in the recent deals. So I think you do have to stick to your discipline in terms of pricing, even when you see a good high-quality asset.